So why don't you walk us through the different ways that you can go about if you're running a volatility book and you're, let's say, long volatility and you're watching your delta change from the gamma. There's different strategies and different techniques for choosing when to hedge. Why don't you tell us what those are, and then explain to us why you like a particular method?
Yeah. So like when you dynamically hedge, and emphasis on dynamically hedge, because like you can just sell or buy options and not touch them until expiry and then hedge once. But when you hedge dynamically, so you need to ask yourself, how much theta do I pay per day? And what's my theta bill on a daily basis? And how much do I need the market to move for me to break even on that trade? So let's say that I'm long gamma and I paid in volatility terms 16 for like, let's say 1 week option. So on average, I need the market to move 1% every day so I can make money. So let's say that the S&P opened today like 43.50, then I need the market to move up 1%, and then once it gets up 1%, I'll sell my delta, because if it moves further, then I'm okay, because I hedged after 1% move, and then I locked 1%. Let's say that it moved to 1% up, then it moved back 1% down, then I can buy back the delta that I sold 1% in 1% move higher. I can just buy it back, and then I can make up for the theta through my delta hedging. This is how a basic dynamic hedging works.
Okay.
Now there are many different ways to do dynamic hedging, and the problem is that you only know in retrospective what the best way was, because option your realized P&L on vanilla options is what we call path dependent, because you only know at the end if you hedged successfully or not, or if you made money, if you had an optimal position like strategy or not, because there are like infinite way spot like an asset can go from point A to point B, like infinite. So basically, you need to ask yourself, is the market trending or not? Is the market mean reverting or not? And based on that, you need to make a decision how frequent you should hedge your delta.
Okay. Some people do it on what, like a time basis? They might do
it. So I came up with 3 ways to do that. So you can say based on accumulated delta. So let's say if I accumulated X amount of shares or X amount of dollars, I'll offset my delta. You can do it based on percent change in the underlying spot. So let's say if the market moves 1%, I'll hedge the whatever delta I have after that move. And you can do it based on time. So let's say that I will hedge every 5 minutes, 1 hour, 1 day, whatever.
Right. Okay. And now you mentioned that some of your coworkers like to make fun of you and say that you are a little trigger happy when you hedge a lot. You're in your delta, you're moving around.
Yeah, they say that I don't know how to sit on my hands and let the move go. I have paper hands. I take profits too soon.
You're the opposite of diamond hands. Now, having said that it reduces the variability in your P&L, does it not? When you're thinking about
but I don't know how to sit on my hands. No. It reduces the variance of my P&L.
Right.
But I hedge too frequently, I guess, because I don't know how, because when I see when you see the variance in your P&L, you're like it does something to you that you don't want to do, and if you are risk averse as I am, so you don't like variance in your P&L, both on making when you make money and when you lose money. So you hedge too frequently.
I guess that's the problem about understanding all of the math behind all of it. You end up being such that you're trying to get rid of the variance in your P&L as well.